What if I told you the 41% crash in silver at the end of January wasn't a collapse at all? What if it wasn't the end of the bull market, but the moment the silver market split in two? Because that's exactly what just happened. And almost nobody is talking about the most important detail. Yes, silver crashed. Yes, it was violent. Yes, it wiped out leveraged traders and terrified weak hands. But while the West was panicking, the East was calmly buying at a higher price. Let's slow this down and walk through what really happened. Because this wasn't random, this was structural. And once you see it, you can't unsee it. The day the silver market broke in half. In late January 2026, silver experienced one of the most brutal sell-offs in modern history. Western paper prices collapsed. At the lows, COMEX futures traded as low as $72 per ounce, a 41% crash. Headlines screamed bubble burst. Commentators declared the bull market dead. But here's the detail that changes everything. At that exact same moment, the Shanghai physical silver price never broke $102. Read that again. While the West was selling silver for $72, the East was still paying over $100 for real metal. That's a 29% premium. That is not normal. That is not arbitrage. That's not noise. That is a market divorce. Paper silver versus real silver. What you witnessed was not a single market reacting differently. You witnessed two different markets revealing themselves. In the West, silver is primarily a paper instrument. Futures contracts, ETFs, derivatives, leverage stacked on leverage. Silver is traded like a financial token. In the East, particularly China, silver is treated as a strategic material, something you fabricate with, something you stockpile, something you cannot substitute. And when panic hit, these two philosophies collided. The most important chart you've never seen. Over the last 12 months, the premium between Shanghai physical silver and Western paper silver has exploded by 1,874%. That's not a typo. That premium didn't spike during the crash. It was already there. The crash simply exposed it. A premium that large doesn't happen in a functioning market. It only happens when price discovery is broken. Their floor is our ceiling. Now here's where it gets even more revealing. During the crash, Shanghai futures also fell hard. They hit their limit down circuit breakers, a full 20% crash. But even at their absolute worst, Shanghai silver bottomed at 94.97. At the same moment, Western futures were trading at 78.88. Let that sink in. China's worst case crash price was still $16 higher than the West's free market price. That's why people inside the industry are now saying their floor is our ceiling. This was not a sell-off in China. Here's another critical detail most people missed. China wasn't dumping silver during this crash. They were cooling speculation, not selling metal. Authorities suspended 5 commodity funds. They barred 16 traders. Not because silver was unwanted, but because demand was too intense. You don't shut down buying when an asset is collapsing. You shut it down when too many people want in. The wealth transfer. No one is talking about. Now connect the dots. In the West, leveraged traders panicked. Margin calls triggered forced selling. Paper contracts imploded in the East. Physical buyers stepped in. Premiums held. Strategic accumulation continued. This was not a random crash. It was a wealth transfer from reactive Western speculators to patient Eastern accumulators, including sovereign entities. The J.P. Morgan signal that confirmed it all. And then came one of the most underreported moves of the year. J.P. Morgan quietly relocated its entire gold trading desk from New York to Singapore. Think about that. This is the largest bullion bank on earth. And they moved their precious metals nerve center closer to physical demand, not paper liquidity. That is not a cosmetic decision. That is a bet on where price discovery will matter in the future. The center of gravity is shifting, away from leverage screens toward physical flow. Why this crash did not break the market. Here's the key insight. This crash did not destroy demand. It destroyed froth. Silver had attracted short-term tourists, momentum chasers, leverage junkies. They got wiped out. That's what crashes do. But underneath that speculation sits something far more powerful. 60% of silver is consumed, not stored. Roughly 60% of annual silver demand, about 680 million ounces, is industrial. Solar panels, EVs, semiconductors, 5G infrastructure, defense systems. This silver is not hoarded. It is consumed, gone forever, and that demand is inelastic. Manufacturers don't wait for lower prices. They buy silver, or production lines stop. That's why the crash stopped at $72. That's why buyers stepped in immediately. That's why silver bounced 18% in days, back to $85. The physical floor asserted itself. This has happened before. If this feels familiar, it should. During the 1970s gold bull market, Gold suffered a brutal 50% mid-cycle crash. The media declared it over. Tourists fled. And then gold went on to rise over 400% to new highs. Now, the crash didn't kill the bull. It purified it. What just changed forever. Here's the real takeaway from this event. We no longer have one silver market. We have two. A Western paper market, an Eastern physical market. One is volatile, leveraged, and emotional. The other is strategic, necessity-driven, and patient. And when stress hits, the physical market sets the real value. This crash didn't end the silver story. It revealed where the story actually lives now. In part 2, we're going to talk about the next catalyst that could force the West to finally acknowledge this split. The emergency U.S. critical minerals meeting, and why governments may soon become the next major buyers of silver. Because if that happens, this market changes permanently. If part 1 was about the fracture, part 2 is about the response. Because only days after the silver crash exposed this paper-physical divorce, something extraordinary happened. The United States government quietly called an emergency critical minerals ministerial meeting, scheduled for February 4th. No hype, no press conference, just urgency. And that timing is not a coincidence. Why this meeting matters more than any price chart. Governments don't call emergency meetings over volatility. They call them over supply risk. They call them when something essential is becoming unreliable. Silver is not just an investment metal. It is a strategic material. And the world is suddenly realizing just how exposed it is. Silver is irreplaceable. And that's the problem. Silver isn't like gold. You can't substitute it. You can't engineer around it. You can't scale technology without it. Silver is embedded in solar panels, electric vehicles, AI data centers, semiconductors, 5G infrastructure, precision weapon systems, every energy transition plan, every AI expansion roadmap, every defense modernization strategy. All of them assume silver is always available. But that assumption is breaking. The supply reality no one can fix quickly. Most people think higher prices bring more supply. That works for oil. That works for copper. It does not work for silver. Why? Because 70% of silver is mined as a byproduct. It comes from copper, lead, zinc operations. You don't just turn on a silver mine. You have to increase base metal production, which takes years. So when demand spikes, supply can't respond. That's why the system cracked under pressure. Why $72 was the floor. When silver crashed to $72, industrial buyers stepped in, not because it was cheap, but because it was necessary. Factories don't speculate. They secure input. And when silver drops violently, they buy faster, not slower. That's the hidden bid under this market. The West finally noticed. For years, Western policymakers treated silver as a sideshow, a retail trade, a volatile cousin of gold. That illusion ended in January. The crash revealed something terrifying to governments. Paper prices can collapse, but physical supply can disappear. At the same time, that was not volatility. That's fragility. Strategic stockpiling is the next phase. China already understands this. They've been stockpiling quietly, restricting exports, prioritizing domestic industry. Now the West is waking up. Late, but waking up. Once governments begin competing with industry for silver, the market dynamics change forever. Governments don't flip inventory. They don't chase momentum. They lock supply away. What happens when sovereigns buy? Let's be very clear. If even a small number of Western governments begin strategic silver accumulation, there's no mechanism to absorb that demand. Not at 72, not at 85, not at 100. Because that demand is non-speculative, long-term price insensitive, and once it starts, it doesn't stop. Why this was a once-in-a-cycle event. The January crash did three things simultaneously. T destroyed leverage, it revealed real demand, it exposed price discovery failure. Those events do not repeat often. They are transition moments. The market you had before January no longer exists. What to watch now? If you want to understand silver going forward, ignore Western paper volatility. Watch three things instead. First, the Shanghai physical premium. If it stays elevated, the physical market is in control. Second, government policy language. Any mention of strategic reserves or critical inputs matters. Third, delivery timelines. When lead times stretch, price follows eventually. The big picture. This wasn't the end of a bull market. It was the moment silver stopped pretending to be a purely financial asset. It is now being reclassified in real time, from trade to infrastructure, from speculation to necessity. And those transitions are never smooth. Final thought. The loudest voices during crashes are always the wrong ones. They look backward. They extrapolate pain. The quiet buyers, the strategic buyers, The ones who don't panic, they look forward. January 2026 wasn't about fear, it was about exposure. And now the world has seen it. If you understand this shift, you're not early, you're just paying attention.